Welcome back to another episode of Gimme Some Truth. Today we are talking about a topic that is near and dear to Wisconsinites' hearts, and that is the Wisconsin retirement system. Andrew and Clint are in the booth today with me. This is something that you have, Clint, you have a tremendous amount of experience with. How many years of experience do you have talking about this topic?
Well, I've been in the industry since, 2001?
Shocking for a guy that's 29.
I know, wow.
Amazing.
Right out of the womb. And then into the Wisconsin retirement system, consulting.
Well, your mom was in it, so technically, yes.
Yes, that is true. So, I mean, my dad was was a federal worker. My mom was a teacher in the Wisconsin retirement system. So, I became very familiar with it very fast. And when I first started, I did tax shelters and annuities for school teachers, and I had to learn the system intimately. So, yeah.
Yeah. Andrew, you brought this topic up. This is kind of your baby this morning. Why do you like this topic? Why do you think that it resonates so much with people?
Yeah, well, of course, a lot of these things come out of recent experiences. So I went down a path with a client where we just went deep into the weeds in their pension plan. And so I'm like, man, this is really can be misunderstood.
Yeah.
If not educated properly, understanding what are the options? How is the money actually invested? All these different things came up. And so I was like, this would be a great topic to expand upon with the group and provide some more because we do have a lot of people that we serve. And just being Madison the way it is, there's just a lot of people out there and they might have questions.
Yeah. What do you think is the most misunderstood part of the plan?
I think it's actually, I think there's two answers to that. One is when I come to generating the income in retirement, what are my options?
Sure.
Because there's two different formulas, and it's on your statement. And we love the WRS, but the statement's not that easy to read.
Right.
So I think it's understanding what my actual benefit is, and then secondarily is can I come and go? Like if I change a career or I go to a different department or stuff like that. So some of those restrictions, I think, are the two misunderstood biggest pieces.
Yeah, I think one thing to clarify too is that when we're speaking about it this morning, we're talking about WRS and ETF. They're not synonymous, meaning exactly the same thing, but for the conversational purpose today, they are. So if you have ETF, we're talking about the same thing. And it's as we talked about off camera here before we got started, we're lucky to live in Wisconsin because it is incredibly well funded. It's incredibly well rated in terms of how these systems work. And I think that that's just a testament to not only the people that run it, but the people that designed it so that it couldn't be kind of touched, if you will, for other reasons.
That's exactly right. And it's well funded. I mean, everyone contributes to it. So in a lot of ways, the nice part about it is that it does act like Social Security. I mean, Social Security is a pension. This is a pension. It's going to pay you for the rest of your life and possibly a loved one's life as well. And it has guaranteed payments. If you select all these different things down there, you're going to get payments for a minimum of 15 years, no matter who survives. So it's a tremendously valuable tool in our toolbox when we can build kind of this floor of income for people and say, this is what Social Security provides and this is what Wisconsin retirement provides. That's kind of the best income. You're never going to outlive it. So we kind of remove some of that risk that people have in their head. They're like, well, what happens if, the market goes down and everything, all the crap hits the fan? And, yes, you can select some more variable versions of the pension plan, but by and large, really solid. A lot of the pension is locked in for you, and you have a situation where you can usually keep pace with inflation there too. So there's a lot of great things about this pension plan, and if we can choose guaranteed income usually versus assets, assets give you more flexibility, but guaranteed income gives you more security, and so people really like having that security.
Absolutely. Andrew, in 30 seconds, can you just explain what is a pension, kind of the most basic attributes of the WRS system?
Yeah, it's basically, let's say you have like a fictitious account sitting on the side that's being funded by you and your employer. It's just accumulating value, right? as Nate mentioned, there's different investment options in there. There's a core and a variable, and we're not going to go down that path today, but there's different investment options in there. And that grows along with as you move along in your career. And so basically, as as Clint just mentioned, you get to the end of the road and you've got this accumulated value, and then you've got a couple of different scenarios where you can start to draw on or turn it into a benefit. So pension is basically just a guaranteed stream of income where you've got some different options about how many payments you want. Do you want it to be elect to offer your spouse to continue the benefit if you were to pass prior to them? But it's basically very short term. Short answer is it's a guaranteed stream of payments.
Can't outlive it.
Cannot outlive it.
Which is, I think that's just the most, Clint's earlier point, just such an incredibly powerful thing to be able to say. Live to 85, live to 95, live to 105. If you pick a spousal option, spouse lives to, it doesn't matter, it pays. And I think that for most people that have it provides a tremendous peace of mind. It is very similar in a lot of ways to Social Security. It's almost kind of if you have two spouses that are both in the system and both getting Social Security, you're going to get 4 streams of income that you can't outlive. That's a pretty powerful thing to be able to start a retirement plan with is those streams.
And it's much better funded, by the way, than Social Security.
Yeah, exactly.
So,
yeah.
We are not at 99% funding in our Social Security. We all wish we were, but we're not. We're significantly under.
They're not staring at 2032, 2033 with trepidation like Social Security is. Can you talk a little bit more about the investment options that reside within the plan and kind of how that works? I think that's a little bit misunderstood for people.
Yeah, I mean, you get the ability to select either the core, your default when you go in there, the core is like 100, you can go 100% into core. And then the most you can do is 50-50, and that's between core and variable. And so, yeah, you can go into that and you can split those contributions if you want. 50% goes into the core, 50% goes into the variable. And it's really out of your payroll, and it's you make this election with ETF. So you got to fill out a form and you got to say, hey, I want to, or now I think you just do it online, but I can just go and my future payments will get split into these 2 buckets.
And the buckets, so core is roughly what allocation, variable is roughly what allocation?
That's a great question, because people have the misnomer of this core is fixed. It's not fixed. They use some smoothing techniques and things like that. I really wish we could do that in our office, bank some future returns and give it to people when the market's down. But for all intents and purposes, it's about a 60-40 stock to bond mix inside of the core. And then variable is more like 100% stock. And so this board manages it. And so employee trust funds manage it. They do a great job managing it. It's the SWIB Investment Board manages it. So State of Wisconsin Investment Board manages it. Very highly rated board. They've done a great job selecting investments. It's not as simple as they just buy an index fund and go away. But for all intents and purposes, we got the 60-40 versus the 100% stock.
Yeah, and I think the smoothing piece of it's important. You and I were managing money, up to and during and then through 08, 09, and we really saw where the core smoothing aspect made the ride significantly easier for the people that were in that bucket versus the people that were in the variable bucket.
Yeah, I mean, variable adjusts, and there's 2 different buckets there with you have pre-retirees that are basically all in one bucket, and then you have your post-retirees. So you have your annuitants that do have different crediting experiences in their investments. But yes, your pension plan, if you have variable that's become a very large part of your plan, the variability of your pension amount that you receive can be significant if we go through a big market downturn. And there is no smoothing in the variable bucket. So that is where it's a little bit of something to watch and be careful. And a lot of people, when they transition over into retirement, you can make a one-time switch from variable back into core. You can never go back. And for some retirees, oftentimes that's something that we chat about, and oftentimes we'll make that move.
Yeah, Andrew, let's say somebody's in the plan, they're a year and a half, 2 years away from when they think they're going to shut it down and retire. Kind of what are the most practical steps that they take at that point in terms of, okay, how should I be thinking about this? Meeting with the advisor, meeting with the board, how do they handle that part of it?
Yeah, I think if it goes back to kind of the core of our business is putting this into their financial plan, right? then it's getting a statement. It's starting to understand like what are the estimates of these benefits,
which is more than just their monthly statement.
exactly. So it's
Annual statement.
annual statement, yeah. So it could be we're going to get an estimate, but some of the formulas are based on like last 3 earning years. So if they're 3 years out, they maybe have some step ups in income yet that we'll have to take into consideration. If they're in the core or the variable, is it a time to make that one-time switch to get into the core to really guarantee that income stream?
Yeah.
Because I think an important piece, and not to regurgitate what Clint said, but if you're in the variable in retirement, then your income has potential for variance. And so if we're talking about guaranteed income streams, it to me, it makes a lot of sense to lock that number in. But going through that planning piece, that math for our clients, and having them understand like, here's an income base. What are your other assets to fulfill the gap, if there is one, is kind of like that step. Because then we can start to really dial in that, like, when do I get to retire?
Yeah, not very many pitfalls, if you will, within the plan, but some that we should definitely discuss. Clint, we hear sometimes people say, I have, WRS or ETF, so I'm good for retirement. I don't need to say beyond that. Can you speak on that idea alone?
I mean, you can retire that way if you want, but you better have had some big income years. That's what I'd have to say to that. And it just doesn't allow for a lot of flexibility. You are kind of, with that, we see people are more of living like paycheck to paycheck that way. Even in retirement then, versus having supplemental assets. I mean, absolutely, if you have the wherewithal to save, you should save. Outside of that, it gives you flexibility. And I really like the ability when you have this pension plan. Sometimes we have people over the years come to us and be like, yeah, I'm a conservative investor. I'm in the pension. I just want to like take it easy. And actually, if you have a lot of guaranteed income anticipated, I believe that that's where you can take a lot more risk and try to get that extra growth in your outside investments, knowing that you have this floor kind of no matter what. So I don't think you need to take speculative and wild risk, but you could certainly increase the risk in your asset allocation, knowing that you have this backup.
Yeah, I think the other risk that we see sometimes is people say, I'm going to take this private sector job because they're offering me 15% more in income, and I like that, so I'm going to take that. My income is going to go from 100 to 115,000. That's a no-brainer. Not necessarily a no-brainer.
Not at all, because the obvious question is like, well, then where are you going to save money for retirement? That's not going to be done. Part of it's not going to be done on your behalf, right? So I don't think they take that into consideration a lot of time when they look at the 15% comp boost. So what does that comparison look like?
Yeah.
Right. So I think, and the second question is, how long have you already been in the pension? I mean, if you're in a career where you could potentially be in it for 30 years, like that's pretty hard to beat when you do some of the calculations. If you're, what we'd call like a lifer, right?
Yeah.
In the plan. If you're less than 5, there could be scenarios where it just makes sense to like pull the ripcord and go do something different outside the plan. But so there's variances there, and there's conversations that I think we can shed light on, one with our experience, but also with the tools that we have to provide like side-by-side comparison.
Yeah, and dovetailing on that, people can kind of come into the plan and go out of the plan. If they don't roll their money out, if they've been less than 5 years, they just can't pick back up where they left off.
That's right. Yeah, and when you're hopping jobs too, there is that consideration of, if you're burnt out, and we see it a lot. They get to that 20-year mark and they're like, dude, I've been doing this forever, and I just got a new boss, or this has changed, and I'm just burnt out, and I kind of want to eject, and I'm going to take that 15% raise. And we go, hold on, this is a huge portion of your retirement. If you stay there, you put in these high 3 years, like, look, this is what's going to happen. And sometimes that helps them get over the burnout, and they're able to kind of go, okay, I see the light at the end of the tunnel, and I can make it through these years. But other times they say, I'm still really burnt out. And you're like, well, that's fine. If you can find a position in the Wisconsin retirement system, we could stay as a pensioner and continue to put forth those years of service in the plan. It's hugely beneficial. So that's why having your advisor involved in that and kind of breaking down those numbers. And in some cases, we've said, we've done analysis for people, and we told one of our professors, hey, look, you're going to have to get 40% more from this place because of here, this, and this. This is what all is happening inside of your high 3 years. And, you've got these years of service. And so it's just not going to make sense. So she wanted to take like this really big time job. And I'm like, you can, but it comes at a tremendous cost. And the benefit programs are wonderful inside of not just the retirement system, but just in the Wisconsin system in general. So, to go into a private employer, you're usually getting much worse health care that's, you're paying a lot more for. You got all these different things like disability, life insurance, all these things that are nice benefits inside of the plan. So you've got to consider all of those together if you're going to make a move.
Yeah, we're not touching this morning on the 403B, the 457 deferred comp, sick leave conversion, any of those benefits within the plan. We're simply focusing on the pension. But you're right. The other kind of just the additional benefits you get within it that people sometimes overlook or don't necessarily compare with a new job offer, and that shiny new job offer sometimes loses a little bit of its luster when we don't look at some of these other factors. So you wrote a great blog post on a private pension. Let's just briefly here before we close talk about private pensions. There are still companies that offer private pensions. Those can be a little different than what we've discovered or discussed this morning. Just to briefly touch on private pensions.
Yeah, the only thing I'd really say about private pensions is that if you have one, congratulations. There's very few of them. There's a handful of them here in Madison. Secondly, is those tend to be a little bit more complex, I think, even than the Wisconsin retirement system, because they may have several different versions of the same pension that have now rolled into this new one, and it depends on employee, like when you started your employment dates. There's freeze-out periods, there's new benefit periods, there's different calculations. So there tends to be a lot more nuance, I say, in a private, because they have, at the end of the day, they have 100% control on whether they shut it down and go to more of a traditional 401k retirement plan, or if they modify it in any way, and they don't really need anybody's approval other than they're privately held. They can do it at their whim. So that would be kind of the thing that I would say is look into some of the specifics, find out what you can. If you have questions, we're here to help with kind of navigating the decisions that can be made inside of a private plan as well.
Yeah, not an uncommon thing for companies to do if they get bought out by another bigger company, for those plans to get changed, shut down. You don't lose your money necessarily in the vast majority of cases, but they likely roll to 401ks or something along those lines. So, Clint, any last thoughts for somebody that's, again, been doing it since they were 6 years old?
Yeah, I mean, I think the main thing there is to get a statement to your advisor. Also, when you look at your statement, I mean, one of the most common pitfalls that I see is that they look at the bottom of that and they know that they're going to get the higher of the two amounts at that certain age. But that does not mean that that's what your pension is going to be, because you're feeding it with money every single year. So it's a snapshot in that day and time. If you basically retired tomorrow, that's what it looks like. So people get a little thrown off by what that pension amount's going to be. There's some tools on the website where you can project out. We do projections all the time. When you're within a year or two, you want to go in and actually see the ETF office. We always tell them, like, look, we could do projections all the time, but you should go to the horse's mouth and just be like, okay, we're going to go there, get all of our questions answered. They are true experts on the plan. Plus little things like, hey, I'm gonna go, and they know all these little tips and tricks about, when to pick your retirement date, when to go in there. They're excellent at what they do. And then you want to make sure that you're also maximizing those high 3 years, things like that. I've seen people that, want to dump out. They're like, hey, I'm tired. I'm like, yeah, but I know you're tired, but I only want you to be tired one more year after that, because, you get this big, if they took a big salary hike,
right,
you got to try to take advantage of those high 3 years. And if you're able to lock in ones, I mean, we've seen some people with $60,000, $70,000, $80,000. They have a, significant, they go up to a provost, or, they have all kinds of extra. They get a chairship or something like that. Their income spikes. And a lot of these assignments are, lo and behold, for 3 years. I don't know how they designed that, but, good job, guys. But, those are ways where you need to stay on for that particular period of time.
Yeah, the nuance to the plan is something you shouldn't take for granted, which, again, we said over and over, but this is why you need to talk to advisors. Some of these decisions within the plan are not ones that you can go backwards on. Once you make an election, once you make a choice, you don't necessarily have the ability to go backwards. And so just for your own benefit, to make sure that you are protecting your own interest and your family's interest, we strongly recommend that you seek out the advice of an advisor that is well-versed and well-accomplished within the plan, because not every financial advisor in Madison or in the state of Wisconsin is. So thanks again for tuning into another episode of Gimme Some Truth. And if you want to hear more about this topic or any other topics, please let us know.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.